Oh, hey, welcome to tonight's live stream. Sorry we have a little miscommunication with the time here. I'm looking live and it still says we have 20 seconds left, but here we go. We're live. Let's rock. Joining me as always is Chris Parrish, Chief Investment Officer, Charles Scavone, Director of Investments. And tonight we have, I like to call this a very special presentation because this is actually our 5th anniversary of doing these live streams, the mid-year review. So we do a first half outlook. We do that typically in January, and that's usually a live in-person event, very nice event. We usually have 80 to 120 clients show up, and then we do the mid-year event here where we're reviewing the first half, what went right, what went wrong, and of course looking forward to the second half of this year, and more importantly, what that means for you and your retirement. But before we get into tonight's discussion, I want to first congratulate our Chief Investment Officer, Mr. Chris Parrish. Chris, what is your son doing right now?
So my son Aiden is in flight school with the Navy, and he's up in the jet for the first time. He's not flying it. He doesn't have the stick in his hands. He's in the back seat, but this is the first time he's been up, so I know he was looking forward to that. So
it kind of gives me chills. That's really exciting. Obviously, you must be a proud father. And any emotions? How are you feeling?
I'll have emotions the first time he lands on a carrier. So yeah, probably not the same ones he'll have, but I'll have emotions then. Right now, I just think it's cool as hell.
Yeah. Okay, so we want to jump right into kind of the reason we do these. We very clearly explained on the first half outlook, and the reason we have a forecast is to create a roadmap so we can have, let's call it a decision map, Charles, as far as if certain events transpire, what might we do over the course of the year? And we talked about this in the first half outlook in January with all the clients in the room. Could you just, let's do a quick refresher, because this is going to be important as we start to get into some of the meat of tonight's discussion, because we're starting to see some of the economic data starting to deteriorate, and some of the things that we initially saw, we're starting to maybe, see some changes. And we're going to discuss all this and what it means for you and your retirement. Quick house cleaning items, though, Charles, before you answer that question. We're going to have a raffle tonight. So the raffle is a $100 gift card to your favorite restaurant. Our marketing department will reach out to you, and in order to register for the raffle, you should see on your screen right now an opportunity to register for that. So go ahead and do that. We're going to do 2 raffles tonight, one about halfway through and one at the end of tonight's program. And again, our marketing team will reach out to you and discuss what your favorite restaurant is, and we'll get that gift card out to you. So beyond getting into the presidential election, what the Federal Reserve might do, the possible directions of the stock market, how your portfolio could be impacted by all of these variables, and cutting through the noise and clearly explaining what this means to you tonight, we're going to start at the beginning. And why do we do these, Charles? Why do we have forecasts? And what does it mean to those watching at home?
Yeah, sure. So it's important. We always try and say capital markets are forward-looking, and that we always want to be proactive and never be reactive. And so in that light, last time we discussed what is a forecast and why is it important. And the analogy we gave is it's sort of like you're about to embark upon a trip with the family, and you want to look at a road map or Google Maps now, right, to sort of plot your course and know where exits are for gas or food, your favorite restaurant for that gift certificate and the like, such that when conditions present themselves, you know which path to take. You can be proactive as opposed to being sort of on your back foot and being reactive. So sometimes it's pretty clear, pretty easy. Sometimes it's a little bit more muddled, perhaps as though it is now, and that makes it even more important to have a good forecast in place so that when we are managing money, we know the appropriate path to take.
And so, Chris, I had a lot of clients come up to me prior to the live stream in January, where we did live stream it, but we also had the big in-person event there, and just kind of sitting around and having a glass of wine with some of our clients. They kept asking, Troy, everyone on the news is saying that the market's going to go down, that we're heading for this hard landing, and a recession is on the horizon, and 2024 is not going to be a good year for the markets. And we discussed that night your forecast for the first half of the year, and we told everyone we felt the market was going to go up. We had a positive direction. What went right with that first half outlook, but also what was wrong? What went wrong that night or that forecast?
Yeah. Well, there's always going to be something wrong, right? Because this is a business of being imperfect. So minimizing your mistakes is probably one of the best things you can do in money management. But what went right? The market went directionally where we thought, up and to the right. It probably went overall. The market went there with less volatility than we had expected. We expected an initial sell-off at the beginning of the year. We got one. It was very shallow. So we were right on direction. Most people, I think, weren't right. We're a little short actually on magnitude. It's gone a little higher than our optimistic outlook, largely because volatility has been lower and earnings have been better. The main thing is the breadth in the market has been a lot more narrow. So there's only 2 sectors year to date that are beating the S&P 500. That's tech and telecommunication. The other 9 sectors that make up the S&P 500 are all lagging. And then even within tech and telecommunications, it's been very narrow. So we've got some data. It'll be actually in my YouTube video tomorrow and Stock Talk with Chris, where I go through the first half, and the title is "Everyone's a Winner, Not," because if you were in the S&P 500, you were a winner, but there's wide dispersion throughout the individual stock.
If you were an investor in the S&P 500, you were a winner. But if you were a company that is part of the S&P 500, there's a very good chance that you lagged the overall market. So the live stream that we're talking about, or the live client event that we did in January, you can actually view that on YouTube. So if you search around the live stream part of our channel, you should be able to find it. It's just first half 2024 outlook. And I think we put out an estimate of roughly 5,200 on the S&P 500, when at the time, most analysts, sure seemed like most to me at the time, were calling for the market to go down, for us to have this hard landing, which has not occurred yet. I say yet because some of the data is starting to point to some uncertainty. But if you want to check that out, I encourage you to go back on the YouTube channel and check that out, because we tend to go against the grain here sometimes, and not intentionally, but I'd say probably because a lot of times the herd that we hear on television, a lot of times they're just wrong. They're kind of in an echo chamber, and a little bit late.
A little late, yeah. I mean, I think it was last weekend in October when we did a live stream, and we were talking about the rally in the fourth quarter and the first quarter. The projection, the optimistic projection I could come up with was about 5,200 into tax day, which is where it got. Now, we're well beyond tax day, and I think the markets are near 54.50 or something like that, which is actually, if you told me volatility would be 12 into July 4th, I could have given you this number. Did not expect volatility to be this low for this long, but it is what it is, and the narrowness of the market is such that I think only 7 companies in the S&P 500 have contributed 75% of the gains year to date. So it's like less than 2% of the companies have contributed 75% of the entire 15 percentage points thereabout the S&P's gained year to date.
So just to kind of reiterate what Chris said there, and make sure that this point drives home. Only 2 sectors out of the 11 within the S&P 500 have actually outperformed the S&P 500. So that means if the S&P is up 15% or so year to date, only the telecommunications sector and technology sector has earned a return or averaged a higher rate of return than the overall S&P 500 at 15%. The other 9 sectors have underperformed. But Charles, what I think is extremely, I don't want to say unique, it quite possibly is, although we have had this concentration of stocks drive the market higher in several of the past 10 years. What I do find interesting is not only that we have 2 sectors that are basically driving the entire market, the other 9 are lagging, but within those 2 winning sectors, there's only a handful of stocks within those sectors that are driving those industries higher.
It's an interesting point, and I'd say, well, that's got to be just crazy when you think about it on the surface. But if you take it a little bit deeper and you look at the contribution to S&P 500 sales, margins, and return on invested capital, those 7 names, actually you can take Tesla out of the list, it's really the Magnificent 6 actually, have driven the vast majority of the growth in those three metrics that our viewers will know that we pay so much attention to. So it's not as though, somebody, the fairies put pixie dust on these names and they all went up. They have very strong fundamentals, and that's being very well reflected in the market.
Yeah, so for those of you that are new to our live streams or new to Oak Harvest Financial Group in general, the core philosophy of our growth investing strategy is to identify companies that we believe exhibit strong sales growth, strong margins, profit margins, and also strong returns on invested capital. So growing sales. If you are growing sales, you typically can charge a higher price. That means higher profit margins. And if you have a management team that has a track record of taking those profits and reinvesting to divisions within the company that provide superior returns, you should drive profits much higher and into the future. Those cash flows will be rewarded by your stock, by investors valuing your stock price more highly today. SMR is what we call it, sales, margins, returns on invested capital. And your point, Charles, is not that, to use your words here, a fairy has just kind of sprinkled pixie dust onto these magnificent 6 companies. It's that these companies are market leaders when it comes to driving sales, expanding margins, and reinvesting profits into segments of their business that drive more profits.
Sure. And so as a result, they garner a lot more attention. And then, it's a whole nother subject that we probably don't want to get into tonight, but it's sort of index composition, how our index is built, and then sort of what then becomes the math that drives the returns of those indexes. And it is worked in the favor of technology, the QQQs that everybody, is enamored with. And even within the S&P 500, those names have become quite large and very important in terms of the contribution to the overall index because they're very large positions. And that math works very well, but don't forget, it also works in reverse. And we've seen that happen before as well.
We're going to get into that just real quick, but first I want to welcome a couple people. We have Les from the Houston area. Les, thank you very much for joining us tonight. I don't know if you've listened to the Retirement Income Show or this is just your first time coming across us, but Les, thanks for being here tonight. We do want to encourage conversations because the purpose of tonight's presentation is not only to share the information that we have with you, but to engage in this interactive discussion, answer questions. The only thing that I will say as licensed professionals, as a registered investment advisory firm, we cannot give specific investment advice. We cannot talk about your personal situation. But generally, if it's about the topics at hand tonight, if you pose a question, the team and I can discuss it and hopefully provide some insight to what you're thinking about. So I do want to encourage you to interact with us tonight. That's going to make this conversation much more entertaining, not just for us, but for you at home. So again, we do have the raffle. Just a Guy asks here. The raffle is simply to win, have the opportunity to win a gift card to your favorite restaurant. We're going to do 2 of those tonight, halfway through and at the end. Okay, so directionally, first half review, and this is before we get into the second half outlook and everything that's going on right now. Directionally, we got that right. The magnitude, we were a bit off, but calling 5,200 by tax day, when everyone else, or a lot of other people I should say, of course some people thought the market may go up, but I think you were definitely in the minority. Not bad, because hitting 54 by June, what is that? That's 5% or so off, but directionally we got that right, magnitude slightly wrong, but the breadth is the one thing that we figured that more companies would participate in the individual growth, and that would also help drive the market higher, whereas instead what we saw was a very narrow sliver of companies, the Magnificent Six, as Charles has now kicked Tesla out of that 7 bunch. They're the ones that really drove the market higher. So last thing before we jump into the second half outlook, I think this is very important to understand because when we talk about the S&P 500, technically it's called a market-weighted index. There are multiple ways, really 2 ways, I guess, maybe more, but 2 primary ways where the S&P 500 can really reach higher levels. The biggest weighted companies in that index, the S&P 500, can have really, really, really good years. The rest of the stocks, the other 450, 490 or so, could underperform. But because those big ones do really well, the S&P could do great. Or those really big companies could have modest years to good performance, and the other 490 companies could do really, really well, and that would drive the index higher. So what we've seen this year, and it's not unlike years we've had in the past, is that a very small concentration of stocks at the top of the index have really driven the market to greater highs. And what this means for you is if you have a diversified portfolio in retirement, you might be wondering why you're not keeping up with the S&P 500. So I want to talk a little bit just about, we all know the importance of diversification. We're not going to beat that horse, but expectations when it comes to retirement, because even when we talk about the economy in a few minutes, retirees are doing really well versus many other people in the economy. But from an investing standpoint, retirees often should have a little bit of a different outlook than just saying, I want all the gains of the S&P 500. This is the benchmark I want to be benchmarked against, because to the point you alluded to a minute ago, years like 2022 happen, and if you're highly concentrated in those companies, the consequences could be pretty severe. But Chris, diversification, non-diversification, from a retiree's perspective, what are your thoughts?
So this gets back into a point I've made on a couple of our podcasts and YouTube videos. In retirement, in near retirement, you can't spend percentages, right? You can only spend dollars. So if you're a retiree or near retiree, if you're looking at your portfolio and saying, I'm only up 5% or I'm only up 10%, the S&P is up 15%, you can't spend those percentages, right? So you're going to need to start to adjust to dollars as you get to be a retiree, because you spend those. Yeah, I mean, and think back to 2022, only 2 years ago. The S&P 500 peak to trough was down 25%. With inflation adjusted, it was down 35%. The leading stocks year to date, NVIDIA, Facebook, Meta, Microsoft, Google. Meta was down 70%. NVIDIA was down 70% in 9 months, right? 7-0, not 17, 7-0, right? So, if you were totally concentrated in the winners right now, had you been that way in 2022, if you're a retiree or near retiree, I think they got shaken out, have sweaty palms, can't sleep, because I know I'm not a retiree or near retiree. In 2022, I felt that way, right, in those stocks. So diversification, it's the only free lunch you get in the stock market. Does it cause you not to beat the S&P 500 in some years because you own other things? Yes, it might. But each financial tool, whether it's the S&P 500 or a dividend portfolio, it's created to meet a different goal and objective. It's not, my goal is to beat the S&P 500. Maybe I need income. Maybe I need less volatility, and I don't need those ups and downs. The Dow Jones, I think in 2022, index was down about 8%, but it provided some dividends. So with those dividends, you were marginally down. This year, it's providing you dividends, you're marginally up. So your ride is a lot smoother. So
it kind of reminds me of, one, I started, as you mentioned, Meta back in 2022 there. I'll never forget. So it's after hours. I'm kind of sitting in here. I'm talking to some of the guys on the financial planning team, and a lot of times we build financial plans together. We work together. And all of a sudden, back in the investment department, which is about 10, 15 feet away from where we were, we hear this, ah. And I go back there a little bit later, and I talk to Chris, and he says, Meta just talked about investing billions and billions more into the metaverse, and all of a sudden you just saw the stock tank after hours. And then, of course, a few weeks later, they finally got the clue. They decided they were going to start to cut expenses, but that story just kind of comes to mind there. Do you any comments on that before we get back to diversification?
No, it gets back to why is Meta stock? Why did it react that way? Is because Zuckerberg decided he was going to spend tens of billions of dollars on something that had no financial benefit that any investor could see. And it's a great business; they generate tons of cash. But people were like, "Metaverse? Don't know what that is. We're going to have to wait a long time to see the results." So they immediately sell the stock, and then they go out and they decide to fire people, and the stock goes up. And you know, a lot of people who follow stocks are like, why did the stock go up when they fired a bunch of people? And it's not because they're evil, the management team is evil, it's because the shareholders are breathing a sigh of relief that they're going to get a lot of that cash that's in the company as opposed to it being wasted on projects that you don't know what the financial outcome is, which gets back to return on invested capital.
Yeah, because as an investor, you cannot quantify any potential future returns with any degree of certainty. When a company says we're going to invest tens of billions of dollars into the metaverse, as an analyst or as an investor, how do you even possibly quantify the potential return on that deployment of capital into this unknown space? You don't. So what do? You say, I'm just not going to touch this. I'm going to dump it.
You shoot
Your
first and ask questions later.
Your investment thesis is no longer intact, right? It's changed.
Yeah.
And so
the roadmap has now changed.
that's right. You hit a big fork in the road, and
and it doesn't just happen in technology. I mean, it happened in energy. You know, when energy prices were in 2005, 2006, 2007, well over $100, $120, and all the companies here in Houston were going out and spending tens of billions of dollars, and energy prices are 110, and you know, all the energy friends of mine are like, well, why is their stock not going up anymore? And it's because the market is really smart. It knows, you know, that $10 billion that you're putting out there, it's going to take 10 years to invest it, and you have no idea what the return is 10 years from now. So the shareholders they're like, okay, I'm going to move on to something that's easier, gives me more visibility until that money's spent and I can actually see cash coming back to me.
All right, we want to welcome Doug from Michigan. So Doug, thank you very much for being here with us tonight. If you have any questions, please drop them into the comment box. Doug, if you probably don't know, says you're not a client, but I was born in Detroit, and I've been a huge Detroit Lions fan my entire life. So you may be a Packers fan if you're in that area, but hopefully you're a Lions fan, and if so, welcome to the family. We're actually going to be, we have a good team now. We're ready to go. We're ready to make the city proud. So very, very glad to have you. And then we have Al from California. Al, you're paying attention because you must be considering leaving California, like so many tens of thousands of people have done. But glad to have you here, Al. If there's any questions that you have, please drop them in the comment box. We will get to them. So we have our first comment, and it actually segues very nicely into where we're going right now. JL says, I got laid off and received a severance. The indicators of a recession scare me. Should I go all in now or DCA? I believe that's dollar cost average, or go or invest your money into the market right now. Well, we can't tell you what to do, of course, because as licensed investment advisors, we don't know your situation. We have a fiduciary responsibility to our clients. This isn't the Dave Ramsey show, although we do appreciate what Dave Ramsey does from a debt management and advice standpoint. We're licensed professionals, so we can't give specific advice, but it does tie very nicely into what we're about to get into. Just before we do that, though, just last comment here. So in retirement, you have to decide, do you want to try to get more rich, or do you want to risk being broke, right? And that's what the decision really comes down to when you're talking about diversification versus non-diversification. I don't think many people realize how concentrated the S&P 500 is, for example, in very few companies. Chris, the stat that you brought up earlier, was it 70% of the returns are from those 5 companies? Or 6 companies?
It was 75% of the return came from the 6 companies. It might be 7. The technology, telecommunications. Yeah, the other 493 companies in the S&P 500 provided only 25% of that 15% return. NVIDIA, one stock returned 1/3 of the total return of the 15%. NVIDIA accounted for 5% of the 14.5% year-to-date return of the S&P 500.
That's even shocking to me, really, because I know the other side of that coin, right, is when those stocks do turn, which is one of the catalysts, because we really have this third quarter and this fourth quarter coming up, and one of the catalysts that could change the direction of the market is the NVIDIA report, not to mention what the Federal Reserve is going to do over the next few months. But when you're in that boat of competing with the S&P 500 as an individual investor, you have to realize that there are just a handful of companies that could cause that portfolio to really, really, really tank. And that's when, of course, you're wishing you were in a more diversified structure and maybe participating in 60 or 70 or 80% of the downside and less, or upside and less of the downside. So point being is that you either can have a diversified portfolio or a non-diversified portfolio in retirement, but however you invest, whatever your investment strategy is, it should be tailored around who you are, what you're trying to accomplish, and really you have to answer the question, do I want to double my money over the next 5, 7, 8, 10 years, or would I rather be comfortable making 5, 8, 9%, 7% and not risk going broke or running out of money? So money has a different purpose in retirement. It's not just about accumulating massive amounts of money. It's about protecting all of the money that you've already accumulated and at the same time developing an income strategy, optimizing the distributions from a tax standpoint, and setting up the other aspects of a retirement plan, healthcare, estate planning, trusts, family, those types of items. Okay, so transitioning now. So we have a presidential election upcoming, and many of you are probably thinking that it is the #1 determinant of the stock market's performance over the next 6 months. But quite possibly what the Federal Reserve does could have a greater impact on your retirement and your portfolio. So what's more important here? And I know this is a subjective question, it's not black and white, but what do you think, Chris? The Federal Reserve or the outcome of the presidential election, what is more impactful to the stock market performance for the remainder of the year?
I'll just go with, history and stats say the Federal Reserve is more important. Historically, the Federal Reserve and the economy sets the tone for what the stock market does after the election. Normally, the economy is still chugging along, and regardless of who gets elected, the market rallies after the election. Historically, the market sells off later in summer. Every year, just election years, just from August till October, it historically sells off. In election years, it historically is bottomed before the election, rallied after the election into the end of the year and then the first quarter of the next year, because the economy exhales and people get back to doing business and stuff. That's normal, right? I can't tell you if this year's gonna be normal or not right now. We're in a slowdown in the economy. Charles and I have talked about it, the data we've seen since February, particularly on the consumer side. After Christmas, I say after January, and the January sales, the consumer has pulled back. Nike just reported earnings after the close, and it was, for Nike, it was a disaster. And pretty much not every, but most of the consumer stocks we're seeing, if you're not at the uber high end selling a Ferrari, you're struggling unless you're Walmart or Costco. Those are the two that have been working, and that's because they kept their prices low. They didn't raise their prices tremendously. So the Fed is #1, #2, and #3 as far as I'm concerned.
If you think about it, maybe the right framework to use is say that monetary policy sets the foundational elements that everything else is built upon, right? The availability of capital, liquidity in the market, and to the extent that they can, the influence upon interest rates directly have a profound influence upon how businesses can operate and what they do. Fiscal policy, politics and such, has an influence, but typically we see so many times there's log jams, there's not the ability of any party, even if you control the majority of it, to really push something through that's meaningful. Corporations love it when there's log jams in Congress regarding regulation and such. It gives them time to figure out what to do, how to operate better. So monetary policy is that foundational element. Fiscal policy are important, but not as much.
Yeah, and we saw it when President Trump was first elected. There are different priorities for various administrations. Trump made it very clear in his first administration that tax was going to be a huge component of his first year in office. Markets recognize that, and you guys remember, I mean, Chris, you and I have talked about it a ton. Everyone thought the market was going to tank if President Trump won. And then literally once, what was it, Florida that turned in his favor? It was like 2 a.m. or 3 a.m. election night. The market was down huge, and then all of a sudden it became clear that President Trump was going to win the election. All of a sudden you just saw the futures markets just spike. And the markets knew that the tax policy would be advantageous for corporations, and therefore they would keep more of their money. Profits would increase, and that means that stocks should go up in value, and it was instantaneous. Point being here is certain fiscal policy has more of a direct and immediate impact on corporate profits than others. Right? So we don't talk about social policy, we don't talk about what's important to individuals or families and healthcare, only because we're a financial firm. This is our expertise, it's the financial arena. When we talk about matters of politics, we keep it within where we have expertise. And that is what's going on in Washington, D.C. going to increase or decrease corporate profits? Because that is the only thing that the stock market cares about. So certain fiscal policy has a more immediate effect, some has much more of a deferred impact, but the Federal Reserve, when they make a decision, you know, it's immediate.
It's across the board. You made me think of something when you were talking about that and regarding tax cuts, and everything that you said is entirely true. I think what becomes more relevant perhaps is the timing with which you do it, right? It would be if you were, you know, when does the Fed sort of come to the economy's rescue is when things are getting bad and you need some sort of a stimulus. Well, the fiscal policy works the same way as well, but it needs to be done in an appropriate fashion. When those tax cuts were made, the economy was actually doing okay. It was done for a political reason as opposed to a true economic reason. So everything he says, right, we need to be careful in watching and seeing sort of what the economic framework is when some of these fiscal policies are enacted, because they can be, you know, have a very short-term stimulative effect and be worse off longer term.
Yeah, and that's part of the reason why the Congressional Budget Office had to score the tax proposals, the Trump Tax Cuts and Jobs Act, in order for it to have bipartisan support within the, maybe it wasn't bipartisan support, but enough Republicans on board to where they didn't face backlash in their communities. So, and that's part of the reason why it is the reason why the Trump Tax Cuts and Jobs Act expires after 2025, is because the scoring system from the CBO, the Congressional Budget Office, in order to make it economically viable according to their assumptions, and we're not going to get into the validity of their assumptions by any means, it's all a political chess match and gamesmanship and mostly smoke and mirrors. But that's why the TCJA, the Trump tax cuts, are going to expire, is because the CBO said in order to score it revenue neutral, these personal income tax rates that you can take advantage of right now, they have to sunset in 2026. So I have to be very careful to not go down this path too long, because I will talk about tax strategy and tax planning and how it can benefit you in your retirement, because that's my area of expertise, but we're here for the second half outlook. So a couple of things here. We have the raffle that's about to take place in about 2 minutes here. So if you have not already registered for the raffle, please do so. The instructions should be on the bottom of your screen here. We're going to do 2 raffles tonight, one in a couple of minutes, and that's going to be for a $100 gift card to your favorite restaurant. We're also going to do another one at the end of tonight's show where we give the same gift card away. So 2 different winners tonight. Please go ahead and sign up for that. Before we do the raffle, we have a couple of questions here. We're really going to get interactive with you guys in this next 20, 30, 40 minutes. Really good question I saw here. Dr. Johnny, do you see the other 494 companies or so joining the performance party in the second half of the year?
It depends. And you know who it depends?
Don't give me that it depends stuff.
If the Federal Reserve comes out and starts lowering rates, then it will lift all the remaining boats.
And that goes directly to what we just said. Is the action of the Federal Reserve more impactful to your portfolio and your retirement than the outcome of the presidential election?
Yeah, I mean, the Fed has, in my opinion, stayed too tight, too long. So And the reason the first half saw such narrow breadth in these tech and telecommunications companies is the Fed has decided to keep interest rates at 5.25, and the vast majority of companies in the S&P 500 can't handle that. They don't grow fast enough. A lot of them have a lot of debt, so they have to refinance it, and they just struggle. You know, the Amazons, the Facebooks, those guys have big secular growth, and they're like, there's not a big difference between a 4.5% interest rate and a 5.25%, you know, when you start to look at their businesses. But if you're a smaller business, you know, only growing a little bit more than the economy, you know, the interest rates where they are right now are killing some of these businesses because the demand is slowing down. So, you know, the Fed, as far as I'm concerned, they need to start to at least talk dovishly soon. Otherwise, they risk later in the year causing a much bigger slowdown than they can actually turn around and make a U-turn and kick save.
And in that particular instance, if they do wait too long, the hard landing that everyone was talking about last year happening here in 2024 could very well happen in 2025. And not only that, we have this situation to where all of these companies have not participated in the growth of the S&P 500 right now. But if the Federal Reserve continues to delay the lowering, or at least speaking dovishly about interest rates, it very well could have a much larger impact on the stock market than the presidential election.
Yes, I mean, you know, I like looking at analogies just because, you know, investors are creatures of habit. They tend to do the same thing. I think the Federal Reserve is doing some of the same things they've done in the past. But right now, the markets have been mimicking for the last 2 years, 1999 through 2000, which was the dot-com build-out, which turned out to be a dot-com bubble in the second half of the year in 2000 and turned out into a recession in 2001 because the Fed stayed too tight too long and caused a big economic slowdown. And that was an election year, right? Everyone was like, oh, you know, stocks always rally after election. They didn't after the 2000 election. They didn't after the 2008 election. Both of those cases were cases where the Federal Reserve kept interest rates too high, too long, and they were slowing the economy. Right now they're trying to fight inflation. I think they've accomplished that goal. They just don't realize it.
Okay, so we have a winner for the raffle. So we have a little bit of a technical difficulty here. Eric, so the red light's not working. Before we announce the raffle winner, let me take a moment here. So I'm going to be over here all night? Okay, all right. If you need to get up and tell me to look at that one, go for it. Heather, who's the winner, who our lucky first winner is?
It's Curtis Pullman.
Curtis Pullman.
He's a client.
Pullman.
Ryan, yep.
Oh, awesome. Curtis, congratulations. You are the first winner of tonight's raffle. So Heather or Megan from our marketing team will reach out to you and coordinate the delivery of that gift card. So thank you very much for tuning in. Don't you go anywhere because we have a lot of good content still left. But Curtis, congratulations, and thank you very much for the opportunity to work with you. Okay, here we go. We didn't finish the question about dollar cost averaging or going all in. We can't give that specific investment advice, but I will say this. You need to have a plan, right? And long-term markets have tended to go up, obviously. So you can look at major events in U.S. history, and the best time to invest is typically now. And, you know, if you invest in a low market after the markets have gone down, yes, your returns on that money will be higher. But for many people out there, a general rule of thumb is, you know, one of the best things to do is just get invested. If you're in retirement and you are a more cautious person, generally you want to lean more towards that dollar cost averaging. But what I will say before I turn it to Charles here, because I think you got an opinion, is if you have a plan and you understand what type of income you're trying to generate, then you can build a portfolio right now that whether the market goes up, it goes crashes, those types of things shouldn't impact you if you build the proper portfolio around the income that you need, the time frame that you're looking at, and what you want to do in retirement. So it's about having an investment strategy that aligns with your income needs, tax strategies, and overall retirement goals.
I'm laughing a little bit myself because now you know I'm like leaning over because One of the things, because this is such a common question and theme that we would see the investment team from our investors that our advisors we're working with, is one of the reasons why we introduced a hedged equity strategy, so that we could create a product which, within the context of everything that you said, provides a better framework that would allow a client to get invested and stay invested more easily without having to worry about so much of the volatility of the market.
Can I jump in here really quick?
Go for it.
I might have heard the question wrong, but did the question say that he'd received a lump?
No, should I go all?
No, but he'd been fired and
received a severance. Indicators of recession scare me. Should I go all in now or dollar cost average?
My question was are you retired, or are you going to go back to work? Right? Because the way I heard the question was that you didn't willingly leave your job and they gave you a lump sum and that you want to return back to work someplace. To me, as I'm not a financial advisor, but if I was a financial advisor, I'd be asking first, are you looking to go back to work? Because if you go back to work, you're going to have a source of income, and then your risk profile in your portfolio can be a lot different than if you're not going to go back to work and you're just like, hey, I'm done for the rest of my life. So.
And look, here's the truth. I've sat with thousands of clients over the course of my career, and I don't know you personally, but I've heard that question enough to know that there's probably some anxiety that you feel when markets start going down and you're close to that retirement age. So I would recommend finding an advisor that you trust, someone that you can work with, and really communicating how you feel, because retirement returns are not the most important thing once the paychecks stop. It's, do you have a plan that can provide you the income that you need, keep up with inflation, help you pay less tax, but a lot of times, most importantly, is can you sleep at night, right? Are you going to be okay? If something happens to you, is your spouse going to be okay? How are we bringing all these different pieces of the retirement plan together? The investment strategy is just one piece of the puzzle. Now, it's an important piece, right? It's like when you start a puzzle, you do the outsides or the edges or whatnot, and you kind of build it in from there. So your investment risk, how much risk you have, is like the foundation of your house. It is the base from which we can then build an income strategy, and then once we have an income strategy, we can then start to create tax strategies. Without investments, there is no income. I should say, without assets saved, there is no investments. Without investments, there is no income. Without income, there are no taxes. So there's a sequence to retirement planning. We call it the Retirement Success Plan here at Oak Harvest Financial Group. Step 1, investment planning. Step 2, income planning. Step 3, tax planning. And it's because those things need to happen in that order to have a successful retirement, in our opinion. So thank you very much for that question. Hopefully, without giving you personal advice, that was impactful. But knowing similar clients just like you from my course of working with thousands of families over my career, have a plan, have someone that you trust that you can work with, and go from there. And be honest and communicate your feelings, because if your advisor does not know your feelings and who you actually are, then they're never going to be able to do the best job that they can. So hopefully that was helpful. Okay, a couple more questions here, and then we're going to transition into a little bit more of the Fed and then the outcome of the actual election itself, how that could possibly push the direction of the markets in one way or the other, and some of the data that we're seeing. Economic data is very important, and we call it some of the grassroots efforts that we make here, which we'll get into, how that is shifting from where it was just 5-6 months ago to kind of where we are now. So that's on the horizon. But first, we have a question from DJM. In general, how near to retirement do you see clients moving from accumulation phase to income phase? Okay, so broad question. I'm not going to go too in depth here because, again, I could talk 20 minutes on this. Simple answer is, how much money do you have and how much income do you need? The larger your need for income, the less risk you should be taking in your portfolio. So we actually have a video coming out on YouTube tomorrow. It's called Forget the 4% Rule, Withdraw 10% from your portfolio. And we go through the math on how this can work. We're using a combination of tools to do this analysis. Eric, is it coming out tomorrow or next week? Next week. Sorry about that. Now, I'm not telling you to invest all your money and withdraw 10%, but I do encourage you to check out that video because there's some really cool strategies within that video. Now, last week we did an analysis of a Dave Ramsey video where he told everyone to invest essentially 100% in stock and withdraw 8% of your principal balance annually. And we did an analysis on that. So I encourage you to check that video out as well. So once you watch those two videos, you'll start to have a greater depth of understanding to the answer of your question. But if you were to pin me down, what I would simply say is if you have a large income need, you probably should start to get a little bit more conservative at first, but you need the plan, you need the analysis run, you need to stay connected to your plan. And if you have a very small income need, you can take far more a risk. You can be more aggressive in the stock market because you're not dependent on that portfolio to generate income. So technically, you're kind of not leaving the accumulation phase from a mindset perspective. But if you do have a large income need, things get a little bit more dicey there. You need to really stay connected to your plan and have that analysis run. Hopefully that helps. John, thanks for joining us, John. He says, as a FIRE, which is basically retire young, is 80-20 stock bonds still good, or someone like me need to go more into 60-40 with volatility and possible recession? I will tell you this, John, and I'll throw it over to these guys for a second opinion. When you retire young, investment risk can be your worst enemy because you have distribution from your principal combined with the potential for market losses. So we have lots of videos on the YouTube channel that discuss this, but we can't give you an investment allocation there. And one thing you don't want to be doing, just in general, is shifting your investment strategy from 80-20 because you think things are good to 60-40 because things might get volatile. I know it makes sense, from a common sense perspective, but history shows us that we're far better off staying committed to one investment strategy and then having a plan that is built around that investment strategy. And if certain personal conditions change, well, then maybe we can change the entire retirement plan. But anything to add to either one of those questions?
Yeah, I don't know you. If I did, I might have a sense for your emotional state when the markets are down versus when they're up. I just know in working 6 years here at Oak Harvest, I as a CIO have at times recommended to our client base, listen, if you find yourself anxious when the markets are down, Christmas 2018, I think the S&P had fallen 20%, and we get calls from our retirees or near retirees, I want to pull my money out. COVID, market's down a lot, I need to pull my money out. If you found yourself historically in that emotional state of getting very anxious when the market's down, now that you're retired, if you are going to make an allocation decision to go from 80-20 to 60-40, the time to do it is when the markets are up and calm, like they are right now, right? You take money off the table, you reallocate it to other assets. You don't do it when the markets are down a lot and volatility is really high and your emotions are really high. So I don't know your specific situation, but if you are thinking that way and you look back at your past, career in investing and said, hey, I pulled the plug at, when the markets were down during .com or during the financial crisis, I would say with the markets at all-time high and volatility at 12, which is about as low as it ever got, except for 2017, meet with an advisor and walk through your financial plan. And if you don't need the money and want to exhale a little, you can exhale.
Saw a recent quote and it said, of all the choices that lay before you, make your decision and be content. And that's the truth. If you're going to make decisions as far as changing your exposure to equities, Chris is 100% right. I'll never forget January 2020, we're doing our first half outlook. So we have 100 clients in the room and we're coming off 2019, which is a really good year. In January 2020, was a couple of months before the COVID outbreak and the market's dropping peak to trough, 40% or so, 45, 35, somewhere in that range. And Chris is, and I believe we have this on YouTube as well. But I'll never forget Chris. He said if there was ever a time and you were uncomfortable with market risk and you wanted to take advantage of the opportunities that kind of lay before you to reduce risk, now would be the time to consider that. Now, of course, we had no idea the markets were going to drop that much and COVID was going to ravage, so many families and the economy and the country. But the point is very valid that when things are really good, the market's very high, and the storms are nowhere to be seen, that's the time where you want to take risk off the table. It's not when the economic storms are gathering on the horizon or the market's down 10% or 20% or 30%. It's too late at that point. You start to make decisions at that time, you could potentially destroy everything that you've built. The time to get conservative is when the seas are calm and you're in a good spot, and of all those decisions that lie before you, make your decision and be content. Charles,
I'm agreeing with everything you said. So, yep, nothing to add.
Okay, so we're going to go back to the Federal Reserve and the presidential election. We're going to do another raffle here in about 10 minutes. And that is the time that we have for tonight, but we tend to go a little bit long if the conversation's good and you're still here. And we're going to continue to answer the questions.
The debate's coming on right after us.
Is it? I think it's an hour after
it
this.
Is.
No?
Yeah,
okay. Yeah. Okay. So, all right. So there's a presidential debate tonight. Now, historically, Chris, you've said for a very long time that the market tends to go up no matter who wins the election. If President Trump were to win, tax policy, a more advantageous approach to corporate profitability could be good for the stock market. And of course, if President Biden wins, that uncertainty would still be removed. It's very likely the stock market would increase in value. But some of the grassroots efforts that you, Charles, the investment team have been conducting with conference calls and some of the fundamental research that you guys do, the data is worsening. And what does this mean right now today compared to, first and foremost, what you thought maybe 6 months ago? But then also, does it really matter right now? Of course it matters from various angles of social policy and other things, but the data is worsening. And it's kind of set up right now not great for either candidate when they take office.
So, we had, when other people were talking about recession and hard landing at the end of last year for 2024, we were talking soft landing. So we're in a soft landing, right? That's why the stock market's up. But the data is getting softer, right? Weaker, which is also normally the case in summer. So you don't know if we're in a summer slowdown, the consumer's just retrenching because interest rates or whatever, or it's going to morph into something worse. Now, the summer usually, the summer rally started the last day in May, which is exactly when it normally starts. It normally lasts into July option expiration, maybe August option expiration. We're getting a big piece of data tomorrow, I guess, on the Fed's favorite inflation number. So if that comes in weaker than expected, maybe the Fed goes out for the next 4 weeks and starts talking about a September rate cut, or even puts July on the table. If they put July rate cut on the table, the markets will go up, right? At least temporarily, and rally, which is all very normal seasonality. So we're in this soft period economically. Like we said, Nike just missed numbers, took down guidance for the second half. We're seeing, auto sales. I turn on the TV now and there's auto financing for a car for 1.8%, right? 2%, which is, the incentives are coming in to try to move cars.
That reminds you of 2006, 2007.
It does. And so, the two exceptions that I bring up for, it didn't probably matter who won, was 2000, Bush-Gore, which was a very contentious election, as all of us were old to remember, the counting votes, hanging chads, and then 2008, where it was Obama versus Romney? No, who?
Yeah.
And, it didn't really matter because the Fed...
08 was McCain.
Sorry. Yeah. And, the Fed had been tightening rates, and they waited too long to ease. And by that time, the momentum to the downside in the economy the ball is rolling, and if the Fed cuts 25 basis points and people are getting fired later in the third quarter and the fourth quarter, 25 basis points isn't going to do a thing for people hiring, right? Or for the houses here in Houston to start selling, which they haven't been selling for the last 2 months as far as I can tell. So,
but what it would do is, from the academic side of valuation, it would probably propel growth stocks, would it not?
Assuming the AI internet build out isn't,
past its peak.
Yeah. Right? And it doesn't have to be, growing at 70% and then 40% sounds great. That is not enough, right? Slowing it goes from 70 to 40 to 20 to 10, and the market extrapolates those things, and it becomes a very difficult.
Right now, you look at a company like NVIDIA, its price is based on the expectation that growth in profits and revenue will continue to soar at some rate similar to what it's experienced the past year. Right. We all know that that's not sustainable for probably a decade, right? So at some point, it's going to come back to earth. Is that fair to say? It's likely to happen?
Absolutely.
Yeah. And
it's not that NVIDIA is a bad company. It's a fantastic company, obviously, because it's up tenfold, and their earnings and revenue are also up 5 or 10-fold the last 2 or 3 years, because they positioned themselves for 2 decades. They came public in 1999 during the dot-com bubble, and they invested in a business. Intel took their eye off the ball, and NVIDIA's been the winner. And there'll be another winner next cycle.
Sure. And I think, to go back to one thing you were talking about earlier, right? Would 25 basis points make a difference one way or another? Maybe not. People forget that there's a tremendous amount of inertia. The economy is very, very large, and there's a lot of moving parts, and there's a lot of inertia there. So it's not going to shift anything on a dime. So you need to be a little bit more forward-looking on the part of the Federal Reserve. And that tends to be, when they do make mistakes, it's because they waited too long to do the right, to make a change.
So the Fed was late to raise rates. I think we all agree on that. They are now late to reduce rates.
Yeah.
Although I tell you what, me personally, I think the economic data up to this point has been better than I believed it would be if they waited this long to reduce rates this year.
They've had a lot of. They've been very fortunate, right? Their margin of error was pretty large.
They walked that tightrope.
Well, did they? Or the economy just turned out to be stronger than any of us expected, including them, right? So, but you know what? That's fine. I'll take luck any day.
And it's one of those things where you have to make a decision, be content with your decisions,
Right.
as we talked about earlier, and then kind of let the data and let the outcome play out, and then adjust at that point. So here we are, and I truly believe what the Fed does will have a greater impact on the stock market. So let's talk about possible outcomes here. So let's say, forget about who wins the election, right? Because the Federal Reserve is the 800-pound elephant in the room. What upside,
That's
downside?
a small elephant, Troy.
It's an 800-pound gorilla. It's the elephant in the room, or the 800-pound gorilla.
Mixed metaphor.
It is. I didn't get what you said there at first. I was like, no, that's the saying. Yeah, that would be a pretty small elephant.
Yeah.
So, okay, so let's say the Fed doesn't reduce interest rates and they play this hard line and they're wrong.
Yeah.
What type of damage could that do to the stock market over the next 6 months or so, regardless of who wins?
6 months probably not horrible, just because there's still enough inertia in the economy. I mean, the market would be back under 5,000. If they stay too tight too long, the numbers look like you go back to where you were in October of 2022, which is 3,800, which is down 20% plus, which is a recession.
Well,
it's
more
a recession.
than that, because going back below 5,000, that'd be a 10% move almost from now. So 3,800.
Yeah, that's true. 25%.
I mean, geez, we're at 54, 55 right now on the S&P 500.
History would say you'd go back to where you were, kind of where this whole rally started, and the whole rally more or less started in October of 2022. off those lows when all the tech stocks started working and stuff. So that's 3,800.
And the opposite side of that coin, let's say they say, you know what, some of the economic data that we've been paying attention to, and it's deteriorating. It really, truly is, at least from the beginning of the year until now, it has not necessarily stabilized. It is still continuing to worsen for the most part when you listen to conference calls and most of the CEOs out there, the other 494 companies in the S&P 500. What happens if they do say, you know what, we see this data deteriorating, we're going to go ahead and cut rates 2 times before the end of the year, a third time in the fourth quarter, or in the first quarter, and a fourth and fifth from there?
So that's the Goldilocks. That's 1995. That's where Alan Greenspan landed the plane perfectly. The market's only pulled back into October, I think, to the 50-day moving average. That is, I think, what we alluded to at some point in the first quarter, where I was like, you can get the markets to 5,800 at the end of the year, and then you can get to 6,000 in the first quarter of 2025, which is funny because that's where a bunch of strategists now have gone with their estimates. But the work that we do, the work that I do behind the scenes on volatility, that's the Fed being perfect, the economy being perfect, volatility being 12, everyone exhaling after the election, doves flying and all that stuff. So right now the data we see in the way the Fed is talking, I would discount that outcome right now a lot more than the outcome of a harder landing.
So things are looking maybe not so rosy if you're going to discount that outcome as opposed to the softer landing.
I still think it's up into summer. This summer rally should be normal, and you get a third quarter downturn pullback. But right now, if you made me, if I had to bet, I'd say it's going to be worse on the other side of the election than better. But it is up to the Fed. If the Fed starts to say, hey, we don't like the continuing jobless claims we just saw today. We don't like seeing Nike stock down $11 or whatever it is, or Walgreens missing numbers. We don't like banks not lending that much. We need to cut rates. Then there's a chance that you have that Goldilocks continue.
I don't think there's any world in which the Federal Reserve, in my opinion, simply my opinion here, makes decisions based on some of that headline material, because they've proven for years since Powell's been the chair that they don't seem to care about that.
They don't, but in the last speech that Powell had, and he's going to be at another speech next Tuesday, which should be a big deal because it's into a long weekend. There shouldn't be, if the data tomorrow is dovish, he's going to come out next Tuesday and be dovish. The last speech he gave, he talked about the jobs data that's released by the Bureau of Labor Statistics being funky.
There was a change in tone.
Yeah, he knows that the numbers that are coming out of DC aren't the real numbers. And he's about the only one out there now who's like, there's something kind of fishy, that things aren't as strong as it looks. But
few years we've talked about on these live streams, in your Stock Talk podcasts on Friday, where the Federal Reserve, they're stuck on this past data from government reports of what actually transpired months ago as opposed to what is likely to occur over the next 2 or 3 months. And that tone has somewhat shifted over the past few months with the Federal Reserve.
Right. Yeah. Charles and I kind of joke. So they have jobless claims. They came out today. I think there were 232 or 235,000 for like 12 of the last 13 months. They've been within 2,000 or 3,000 jobs of each other every month for like a year, which on a
seems like a statistical
it's impossible. We have like 165 million jobs or something in the country.
I could have a hole in one on 4 holes in a row.
Yeah, so the data doesn't make sense because it's coming out of DC. Yeah. But Jerome Powell actually, for the first time publicly in his last speech, said something's fishy.
Something's fishy.
Yeah.
Well, it only took them decades to figure it out. Okay, so we have the raffle. We're going to give the second winner of the raffle right now. If you have questions, guys, now is the time to get your questions in. We do have a couple that I'm going to address. But if you have questions, now's the time to get the questions in. And then, hey, let us know also if you're going to watch the debate tonight, because I'm personally, I don't think I am. I may catch the highlights. If I have nothing to do, I might actually catch it. But I'm kind of leaning towards not watching it, just because I know what Trump's going to say. I know what President Biden is going to say. I know what the moderators are going to do. I've seen this show before. Just curious if you're going to tune in. If you are, put that in the comment section. Maybe we'll talk about that a little bit as it pertains possibly to what they talk about in the markets. So, Heather, who is our second winner of the night? Mike Bartay. So, Mike, congratulations. You are the second winner of tonight's raffle. That means you are going to be contacted by our marketing team, and they are going to discuss the delivery of a gift card to your favorite restaurant, $100. Thank you very much for registering tonight, and of course, thanks for watching. Mike, if you have any questions before you take off, please put them in the comment section. We'd like to close this out with a good discussion with any questions that you guys have. So Just a Guy says, replay of last year, 10 to 15% drop, late summer to October. I like the question because we've been talking about internally, and I think on the podcast as well, that we could possibly see a 5 to 10% pullback late summer into the election. How do you still feel about that?
So yeah, you pretty much nailed it. I think normal, if you're up a lot like we are, you normally get 5 to 10%. Last year, I think it was almost exactly 10%. Like it might have been 10.1% or something like that. And it was perfectly August expiration till the end of October or October expiration. So, someone had a map of what is normal. Right now, what we see in the markets, whoever's trading it has that same map. The issue is I can't tell, we can't tell, no one can tell yet if that map stops. If there is that sell-off, that normal summer sell-off, because the economy's weaker, because people are afraid of the election, who knows? Earnings are slower like they normally are in the third quarter. If it stops at minus 10%, which is pretty much where we were 2 months ago, it would be 5,000 right now, I guess, or it gets worse, and I couldn't tell you.
Well, Charles, I brought this point up earlier when we were talking. Many of you may remember this, but I lose track of time. So for so many years during the ZIRP period, the zero interest rate policy period, bad news was good news, meaning all the bad economic data that came out, stock market responded positively. You'd have jobs report is horrible, companies laying off workers left and right, any bad news you could think of economically, the stock market reacted positively to it. And the stock market reacted that way because it meant the Federal Reserve was going to keep interest rates much lower for longer. That's kind of, I don't want to say the devil's advocate right now, but we have an economy that is deteriorating. It doesn't mean it's not good, because there is some good economic data out there, but it is trending down on a relative basis. But the Federal Reserve could come in, save the day, and instead of what Mike says here, or Just a Guy, 10 to 15% drop, which the math says, the charts show is a possibility. Last year it happened. Instead of that transpiring, could the Fed come in and save the day by lowering rates or speaking dovishly soon?
Yeah, well, you look like you had something to say.
Well, it's just what you're referring to if you listen to CNBC and all of the Fed put. Question is the Fed put back in play, right? The Fed has tried over the last 2 or 3 years by raising rates, saying, hey, the Fed put is not in the market. And the $1 trillion question, and the question of what cycle is it? Is it 2000? Is it 2008? Or is it 2009 through 2016? 2009 through 2016 or whatever, the Fed put was there. So every time the economy slowed, the Fed would lower real interest rates. They're like, okay, we're too tight, we're gonna lower rates, we're gonna keep rates low. Back in 2000 and 2008, the Fed didn't jump in soon enough. and real growth, real interest rates plummeted very quickly, and the markets, sniffed it out and plunged. So that's the trillion-dollar question: is the Fed going to be back in play with the economic slowdown we're starting to see?
And so with interest rates, the zero interest rate policy, there wasn't as much of a Fed put even available to use, right? You're at the lower bound of rates. They had to come out with, alternative means of lowering rates, quantitative easing and such. So part of the bigger plan here by the Fed is they had the opportunity, they waited a little bit too long, but with the way things were going in the economy improving, you can raise rates, right? And so that then you now have the ability such that if the economy were to slow, you do have the ammo to help combat and create. The whole role of the Fed is to soften the severity of cyclical boom bust to make the economy operate more smoothly. Whether they do that or not, whether the Fed put exists or not, I don't know. But going back to your question, is bad or is bad good? It's sort of, again, it depends a little bit upon your starting point, right? So now markets are high, the economy's running well, better than we expected. Seems you have more downside than you have upside at this point, right? Even now, if you listen to what we all just said, even if the Fed were to come in and speak dovishly and imply that they are going to lower rates, we're talking about 6,000 as the high on the S&P 500. But you think of the corollary to that is if they have made a mistake and you do go into a recession, well, the downside is much more extreme.
It's the asymmetric risk versus return that we talk about so often internally. Is there more risk on the table right now, or is there more potential profit to be had? And when you're in retirement or approaching retirement, risk takes on a different value or weight in the conversation because you've accumulated your wealth, right? It's not about doubling your money every 5 years or 10 years. It's about not cutting it in half every 5 to 10 years. So right now, it's pretty safe to say that there is an asymmetric risk to return profile within the market. Now, last thing, couple of comments, and then we're going to close this out. What if President Trump wins, speaks positively about all these good things he's going to do for business, taxes, et cetera, and the Federal Reserve lowers interest rates 2 times before the end of the year? Could that possibly make a case to see maybe, 63, 6,500? This is kind of la-la land here. It's definitely, nothing to be taken seriously as far as the conversation, but it's conjecture. It's
next year?
It's opinion.
Next year?
No, this year.
No.
Federal Reserve, 2 rate cuts, Trump wins, not possible.
No.
Okay, so when we're simply doing this asymmetric risk return calculation, so let's say 6,000, right? That could be possible.
I can get their math.
Okay, you can't get to 63.
I can't.
Okay, so 6,000 is about 10% from where we are now at the S&P 500. 6,300 is about, let's call it 7-8% from here. So we're looking at 7 to 8%, which mathematically you can't get to, but let's say 5 to 7% is 5 to 6%, let's say, is possible upside from where we are here. But downside, I heard you say 3,800 earlier. If we have economic data continue to deteriorate, the hard landing, meaning the Federal Reserve plays hardball here and doesn't cut rates or speak dovishly. So 3,800, Charles, did you do the math?
Yeah, it's down about 35%.
35%. So we have an asymmetric risk to return profile here. So now if you're in the accumulation phase and you have 30 years before you need this money, I wouldn't worry about it personally. I'm not going to sell anything leading into a potential market downturn. But if you're in retirement, this is where some hedging strategies possibly come in. This is where diversification is extremely important. But the most important thing is to have an investment portfolio that is structured around your willingness to take risk. If you're willing to ride out a 20% decline and you won't lose sleep at night, you probably don't need to make any changes. But if you don't know what your potential losses are within your portfolio, maybe you should find a second opinion. Maybe you should rebalance. Maybe you should reallocate. So doing some math there, I'm not a gambler, but I understand the basic premise of gambling. If my potential downside is 25, 30%, and my potential upside, let's call it 5 to 10%, you know, I don't think I would take that bet.
Well, and you know, short-term interest rates right now are 5.25% as well. So you know, if you're a retiree, you know, you're getting paid to sit in cash by the U.S. government too. So, you know, if you're not a retiree, if you're in the accumulation stage, you know, people keep talking about the lost decade. Well, if you're a pre-retiree, if you're in the accumulation stage, you actually want a lost decade. I mean, it doesn't feel good. I've been through them, but you want 10 years of the market going nowhere so you can just dollar cost average and keep putting money in, because you don't need the money till retirement, and then you want the market going up, you know, as you retire, right? Breaking out to a new bull market right after you retire, not, you know, I just retired at the top of the market. So, you know, call up Oak Harvest, you know, give us a call, meet with an advisor, and we'll walk through the numbers to see, you know, as I say on my podcast, you know, what do you need and what is your greed? Yeah. They're two different things.
And no matter your situation, no matter wherever you are, find someone that you trust. You know, whether it's us, whether it's someone else. If you trust someone that has the expertise, there's really two components here. One, somebody you trust. But two, they must have the expertise in the retirement arena, because the goals are simply not the same. In order to have success in retirement, you need to bring together the strategy for how much risk you're taking, the investment strategy, how much income do you need, when do you need that income, if something happens to you, will your family be okay, will your spouse be okay? So investments generate income, and then the tax side of things. How are we going to help you pay less tax over time? So those are the three things that really need to be brought together. And if you have your willingness to take risk understood, and your portfolio is built such that you can generate the income that you need along with the tax plan, if the market goes down 20 or 30%, your retirement should not be impacted. And that's because your portfolio was built with the expectation that these types of things will occur. So have those things together. Find somebody you trust. If you'd like to have a conversation with us, of course, we're always here. But that's it for tonight's live stream. Charles, Chris, give you guys one opportunity here to provide any nuggets of wisdom. And real quick, Dr. Johnny says he's staying far away from tonight's TV show. Dr. Johnny, thank you very much for tuning in and participating in the live stream, the interactive portion tonight. Really appreciate that. Mike says 50-50. Interested if it will be neutral or not. And then BC says he's going to watch the debate for entertainment because there's not much on HBO these days.
Well, to Dr. Johnny, I guess, pay more attention to the economy versus your political views as it relates to your investment portfolio.
Yep, and most importantly, have a plan, right?
Yep.
You have a plan, all those things come together. You should be okay as long as you can stay connected to that plan. All right, so our next live stream is about a month from now. Please share this with someone who you think may benefit from it. If you have any questions, reach out to us personally here at Oak Harvest Financial Group. Charles, thank you very much for tonight. Chris, as always, thank you very much for tonight. And thank you very much for participating and watching tonight's live stream. Enjoy the debate if you're going to watch, and we hope to see you soon. Have a good night.